Good morning and welcome to the Big Forex Breakfast. On behalf of QUBE Events, my name is Lily Pavliou, and I'm so excited to welcome you today for what is truly a global FX webinar. It's truly exciting. We are so privileged to have Contentworks agency partner with us on this FX breakfast this morning, and we're really so happy to have their contributions and their insights. That's really added so much value. Before I hand over to Charlotte Day, I'd like to say a few special mentions. Firstly, to our sponsor, iSpiral, who have supported this event. We thank you so much. I believe they'll be doing a 20-minute presentation where they'll be diving into a little bit more information about their company's products and services. So we're really looking forward to that. A very big thank you to all our speakers. As I said, it's a global breakfast this morning. We have speakers from the US, from Australia, from Europe, from Asia. So it's truly so exciting. So thank you to our speakers who've taken the time to prepare and to contribute, and we really are so happy about that. To our participants, thank you all for dialing in today and for making the time as well. And of course, to the QUBE team, Hannah and Raluca that are behind the scenes right now have been so involved with the marketing and the sales, and Marta, of course, on the stage, who will be introduced shortly, for putting together the content that is truly amazing. So thank you so much for that. And without further ado, Charlotte, I hand over to you. And sorry, Desmond, joining us from Singapore, thank you for chairing the event. We're so happy to have you. Thank you so much for that. And with that, I'm handing over to Charlotte. Thank you so much, Charlotte.
Perfect. Good morning. Thank you so much, Lily. Welcome everyone to the Big Forex Breakfast. We're so excited to be doing this event. This is the first event of this kind that we're actually organizing. Contentworks agency, for those of you who don't know, actually work directly with brokers, with fintechs. So we've been working very closely with QUBE events during this, I don't want to use the word unprecedented times, but we've been working very closely together to organize webinars. And we're really interested in hearing directly from brokers, directly from the sales, from the marketing teams, because really this is the best way that we find to address the challenges that we're all facing. It's a highly competitive industry. We all know that. It's dog eat dog, broker versus broker. But at the same time, we're a really close-knit community, and you see that when we all come together for our networking events. So as we're moving into this morning's agenda, I want to remind you all that we're using hashtag Big Forex Breakfast. So do go ahead and tweet your screenshots. If you're having breakfast, send us a tweet of those as well, your insights and your thoughts. We're also going to be running a poll on the right-hand side. So we're running various different polls throughout the day that you can take part in. And before I do hand over, I just want to reassure some of you who were asking, is there going to be a real Forex breakfast with real burgers? Yes, there is. Probably not this year, but yes, there is. We're working on it, and we're really excited for that to be happening as well. So thanks again to all of our speakers, to our sponsor, iSpiral, and our amazing chairman, Desmond Leong, who's going to be taking over from me in a moment. Wishing you all a fantastic day. Thanks, everyone.
Thank you. Good day to everyone. Desmond Leong, and I'll be chairing the Big Forex Breakfast today. Just a quick introduction about myself. Yes, I run Everest Fortune Group, and we specialize in helping CFD and crypto brokers differentiate themselves in this increasingly competitive landscape. With a goal to increase their acquisition, retention, volume generation. And we also work with over 15 of the largest brokers, from Australia to UK to Cyprus and the Cayman Islands. Anyway, enough about myself. I hope everyone's excited about today. In this increasingly competitive and changing landscape where brokers are, always seem to be offering even lower spreads, right? And even lower commissions. With some, guys like Robinhood, even offering entirely commission-free trading. So it really begs the question, where is the direction of this industry heading? We can't possibly live in a time where we're always lowering our spreads, we're always lowering, our commissions, and even begs the question whether, we see a time where we end up paying clients to trade with us. I think I've seen some of those promotions being run. I'm not sure how effective they are, but anyway, you know what they say: you only compete in price, right? If you can't compete in product. And today, I feel we'll address this big question on product. How can we better differentiate ourselves, right? What kind of risk strategies, sales strategies, and marketing strategies can we really adopt in these changing times, where more and more of us, more and more of the traders are in the online space, right? So sit tight. Enjoy today's wonderful session as we pick the brains of the leading minds in this industry on how we can better navigate this landscape. I'm just really looking forward to the juicy sales strategies and the exciting, marketing strategies that we're going to discuss together. Right. Thank you very much. And now I'm going to pass on the time to iSpiral, our sponsors for today.
Good morning, everyone. Let me share my screen as well. Just very quickly. Okay. It's a pleasure to be part of this great event. My name is Christos Tiniozu, and I'm the managing director of iSpiral. And today, myself and Haralambos will be presenting to you a regulatory matter that I'm sure you will find interesting. The title of the presentation is How Technology Can Help You Comply with the Advertising Regulatory Guidelines. A few things about us first. iSpiral is a leading regulatory technology provider with a vision to contribute to a financial crime-free world. Over the past 13 years, we helped more than 200 financial institutions meet their compliance and regulatory obligations using our technology in the areas of client remote onboarding, KYC due diligence, anti-money laundering, risk assessments, compliance obligations, and content marketing compliance. Our compliance platform is designed by compliance experts who understand the challenges that the compliance officers are facing every day. Just a quick preview of our clientele, which includes, amongst other, 6 major banks and 50 firms within the Forex and investment sector. In total, we have over 200 clients from the financial industry, including leading payment service providers and EMIs, as well as organizations from the gaming and insurance sector. Sorry for that. In these slides, you can see some of the technology solutions that we have developed. The first solution that you see is the image content monitoring tool, which is a dynamic tool that analyzes advertising images and can detect whether those advertising images comply with the regulatory requirements set by your regulator. Now, we will be drilling into this regulatory subject and solution later in the presentation. The next one is a client lifecycle management solution for onboarding and KYC. This is basically a solution that covers the whole lifecycle of your clients, from onboarding to due diligence, to risk assessment, to mitigation actions, as well as AML ongoing monitoring through an omni-channel UX experience. With the transaction monitoring and screening solution, we can identify abnormal client transactions, and we notify compliance officers on possible money laundering and fraud cases. We do those checks either before or after the execution of the transaction. We also check payment transaction messages such as SWIFT, SEPA, and ISO 2022 against sanctions list. Also, we provide several identity verification solutions, which include aggregation of hundreds of external data sources, such as governmental, credit bureau, and utility list. Right now, we can verify over 4 billion people and 100 million businesses with a single API. Over and above that, we offer video identification, both automatic and through a live agent that covers liveness, document verification, biometric face authentication, as well as advanced digital signature. As far as PEP sanctions and adverse media, most of you probably have this one. So you either doing it searches manually through a web portal, or you have integrated the API of the vendor within your CRM. Our differentiation here is that we have connectors to the biggest data providers, and we provide a single API to our clients. Also here, we offer ongoing monitoring and batch monitoring at very competitive prices. Now, I think what distinguishes us from other competitors is that we heavily use in our development artificial intelligence and machine learning to analyze images and to detect abnormalities within the transactional behavior or profiling of the client. So as I said before on my previous slides, in today's presentation, we will be focusing on how to monitor social media advertising content that your affiliates are posting within their social media accounts. We will show you how compliance officers can monitor the social media content without restricting your marketing strategy. So Charalambos, which is our iSpiral marketing compliance expert, will take over the stage now and will take you through the role of the regulator in the context of social media advertising. Charalambos?
Good morning. Good morning. Thanks for introducing me, Christos. My name is Charalampos, and I am the Sales and Marketing Officer of iSpiral. So, the regulators have the responsibility to protect the consumers and the market. Now, because of the increasing amount of non-regulated content that financial brands are using, the regulators are taking measures to mitigate this huge problem, either through fines or even suspending licenses. That leaves Forex and investment firms in risk, since it is difficult to monitor the complex marketing operations due to the volume of affiliates and other introducing parties they cooperate with, especially as far as the advertising and promotion content goes. Regulatory bodies like SISEC and FCA have directives to guide firms to advertise products and services clearly and give consumers fair information, which should not be misleading. The three main types of content that is considered not regulated are financial promotions, which might indicate that consumers can earn money without displaying the risk. The other one is clearly showing risk warnings and other required statements because consumers should base their decision on visible and understandable information. Furthermore, advertising images need to include the above regulations in both written and visual content. Financial promotions are usually highly influential when it comes to affecting the purchasing behavior of consumers. Regulatory bodies imply that attractive headline rates of return that only a small amount of consumers can obtain, and keywords like invest, earn, and wealth are encouraging consumers and are promising things that are not achievable. As you can see in the example, the content has a promotional tone of voice that is perceived as misleading due to the second sentence mentioning that the firm invests in trade tech so it can help clients have the best returns by investing in stocks and shares, which is a form of non-compliant content. Another example of compliant and non-compliant content can be seen in those two Twitter posts. The first ad is not balanced, as it shows only the profit potential without warning consumers of the potential lost, while the second advert is informative, describing the product clearly and including a risk warning without being unfair to consumers. By law, the risk warning and other required statements should be bold and with visible fonts. The compliant banner example displays a clear disclaimer that the consumer can easily spot and read. The second banner is listed as not compliant due to the risk warning being not visible and clear, as it uses small fonts and it's lost in the standard text. Regulations surrounding image advertising are following all the above, as the three fundamentals, which are clear, fair, and not misleading, must be taken into consideration. As FCA stated, images can include a company's logo or any other image interlined with the brand, a reference to the types of regulated activity provided by it, and a contact point. However, if the image contains promotional text, portrays wealth by depicting gold and money, or even presenting a wealthy lifestyle, is highlighted as not compliant. The reason is because such content does not give a fair and prominent indication of the relevant risk. The question here is your marketing and your business ready to adapt to these changes happening by regulators? Okay, I'm sorry. Marketing itself is an ever-evolving process. From the 1700s, when the first newspaper ad appeared in the UK, and the radio ads of the 1920s, to the first TV ads airing in the 1940s, and the revolution during the cable TV era, marketing never ceased to amaze consumers and capture their attention. The digital age was the first time that saw marketing gaining immense capabilities. With the gadgets and software available, almost anyone can generate content and promote it fast and easily through social media platforms. As IBM stated, 90% of all digital data was created in the past 4 years, and to think that the World Wide Web has been publicly available since 1991. This increase in promotional activity and content is perceived as a plus for marketers and can strengthen their campaigns. On the other hand, compliance officers find themselves overwhelmed with the rapid developments of marketing because they are obligated by law to monitor all marketing activity. But the challenges of compliance department do not stop here. Marketing is not just another part of your business, and we understand that. The market gets more competitive as the time passes, and advertising is a strategic tool that can help your business stand out. Companies operating in the competitive industry like the Forex sector, maintain complex marketing structures, consulting affiliates, introducing businesses and other partners. And the fact that each one of these advertising partners operates through their own social media profiles, it makes it difficult for compliance officers to monitor everything to detail. The overall situation creates a rupture in the relationships between your marketers and your compliance officers. On the one side, you have the marketing department, which continuously employs new strategies and technologies to achieve its goals. And on the other side, your compliance officers need to monitor and make sure that the promotional material used is in line with the latest regulations. The outcome of this conflict finds compliance officers restricting marketing funnels, like certain social media, leaving marketers with fewer options. The reason is that if the content posted is not compliant, then your firm is at risk of receiving fines, or as we said previously, even lose its license to advertise. In both situations, the results are unwanted. At the end of the day, who can blame the restrictive approach of compliance officers when they have to deal with third parties who have a main goal to generate revenue, and this pushes them to aggressively promote their offerings with content like the two images displayed on this slide?
Thank you, Haralambos. Now, the answer to some of the issues that Haralambos touched in the slides that he presented is called social media image monitoring solution. Our content compliance solution uses image scanning technology that looks for non-compliant text and objects within each image that is posted within the affiliate social media account. So in a nutshell, we detect and separate all objects from one another. Then the solution can identify the profile of each object. For example, if there is a bottle of champagne, a luxury car, euro, dollars, or even if there is nudity within the image. With the text and keywords monitoring, the tool ensures accurate detection and extraction of text from the images that might not be in line with the regulations. For example, keywords such as win, profits, invest, diamond can be detected, and the solution can give you an actual alert. Another key feature of our solution is celebrity matching. So basically, we compare the faces that are on the image ads with celebrity databases. With the latest fines that FCA has given for fake celebrity endorsement, this feature is actually very useful for compliance officers. Now, our social media image monitoring solution operates across major social media platforms like Instagram, Twitter, LinkedIn, and Facebook. On the right side of the slide, you can see some examples of non-compliant content that our tool has detected. You can see clearly why those images are not compliant. Now, for the viewers that are more technical oriented, I'm showing some actual mind-blowing numbers. With our solution, we can analyze over 50,000 images in just a few hours. I mean, you can see that by having this technology, you will be able to even screen an affiliate before partnering with them, instead of going into their accounts and just browsing on the images that they have already posted. I should say here that the images that we extract are stored into a temporary storage until the compliance officers review the alert. You can even save the images and the alerts for an unlimited time. something that affiliates do, and this is from our experience, is that they post a non-compliant image or a story, and then the next day they remove it. With our technology, they will not be able to do that. Now, as far as the current development that we're doing, our team is currently working on text mining, which will allow the tool to monitor the text content of websites as well. With such feature, our advertising-related regulatory solution will become ideal for monitoring all digital marketing content, so your compliance officers can focus on actually what really matters, and your marketing team can onboard affiliates faster without the long waiting times for compliance approval. At this point, I would like to thank you for your attention and enjoy the rest of the event. Thank you so much.
Oh God, so sorry, guys. It's the thing, you just mute it, and I'm like, I'll mute it later, and there I go. Anyway, guys, retake. Good day to everyone once again. I would like to invite Ethan Pierce, director at the Crypto Asset Institute and founder of Borderless Ventures, on stage. So what he'll be doing is he'll actually be doing a solo presentation on tokenized securities and the future of investments. This time with a particular focus on regulatory compliant tokenization. So this solo presentation will be a well-recorded 80-minute video that Ethan has put together. And I would like to remind everyone to continue to ask questions as Ethan will be taking these questions in a live Q&A session right after the video ends. So that's it for me. Ethan, over to you.
Hi everyone, I am excited to be a part of the Big Forex Breakfast and get to share with you about tokenized securities and why I feel that they are the future of investment. My name is Ethan Pierce, and I'm the founder of the Crypto Assets Institute, advising government administrations, large corporations, and investment funds on crypto assets, tokenized securities, and the opportunities and risks presented by the blockchain economy. I'm also partner at venture capital advisory Borderless Ventures and director at Quantum Economics. This is a short version of this keynote, so I'm going to go through the slides fairly quickly. I'll try and address any questions in the chat, but don't hesitate to connect on Twitter and on LinkedIn. And of course, I am not a lawyer, and this presentation is neither legal nor financial advice. If cryptocurrencies like Bitcoin are considered programmable money, then you can consider security tokens a version of programmable ownership. So why crypto assets? That term has become really the umbrella that covers, one, digital currencies like Bitcoin or Ethereum. Digital tokens, these are the things you might have heard about with ICOs, utility tokens, all the kind of different things floating around like that. And more important, the one we're going to talk about right now, which is digital commodities. So when I talk about tokenized securities, you've probably heard the words security tokens, security token offerings. These are the same things, but for clarity, I prefer to say tokenized securities because the emphasis is on the fact that it is a type of security that has been tokenized. But anything security tokens or STO is probably talking about the same discussion. Security is just a fancy word for a tradable financial asset. I imagine you know that, but sometimes the word freaks people out. They don't really know what that's supposed to mean. And why would we want to tokenize securities? Well, there's a number of things that we're going to look at. The first is democratization. Tokenized securities will create a future where even those with small amounts of capital are able to invest in high-performing assets. Number two, fractional ownership. The issue here is the ability of tokenized securities to break high-performing assets down into smaller investable pieces with the added value of digital ledger technology. I think that will really define the future of investment. Liquidity, either regular or punctual. I don't think that most tokenized securities are going to have a lot of constant or daily liquidity. If we imagine pieces of certain real estate deals, or maybe a tokenized film fund, or tokenized venture capital funds, a lot of these things may not necessarily be liquid every day and have lots of trading volume, but simply having the option to move in and out of an asset is going to open up investment opportunities and help recycle capital. There are a lot of efficiencies related to tokenization. The first foremost, because this is automated and because the blockchain is the trust authority in this situation, it becomes 24/7. It means we don't have to deal with long delays for settlement. It means that no matter what time of the day you decide you want to buy or trade a particular asset, you can, because the processes are handled by the algorithms, by the digital ledger, by the processes that are running that, and they don't need to be manually managed by a settlement house, for example. We're going to see reduced fees. Again, because all of this is automated, the fee structures will potentially be significantly less, especially when we start looking at secondary market trading. A very interesting thing with tokenized securities is also this idea of programmable corporate management. We're talking about dividends and revenue sharing. The fact that many of these, as we'll see, are revenue sharing notes, that's going to be something that is not necessarily managed manually, but can be done through what is called a smart contract, which is the way that the blockchain is programmed to automatically take all of the funds or that are available, for example, in the revenue share, and distribute it fractionally to all of the token holders. If we're talking about some of the stuff we'll see with startups or in other places, there may be voting rights or other governance issues, that those can also be baked into the smart contract, or other ways that are programmable. All of this is going to create reduced legal expenses, simply because even though on the front end creating a tokenized, a primary issuance of these tokens can still be expensive. IPOs are also terribly expensive in order to make happen. But what gets very interesting here is when we move to the secondary market, on the fact that it is a type of security that has been tokenized, but anything to $1 billion, potentially claim that it's more. When we look at things like Telegram that had to give back $1.5 billion of it, we also see that it might be less. So the idea here is that's a lot of money. But if we look into startups and scale-ups, they raised around $136 billion in venture capital in 2019 in the US, and more than $250 billion total worldwide. So that's already a step up, and we're looking just in the startup space. So if we look at SMEs and the that revenue growth, so these are generally revenue participations and revenue sharing, the idea there then is that people might have an extra $10,000 or $25 or $50 or $100 that they could invest into helping this company get to that $2 million number. But for the company, what's interesting is they have not had to give up any of the equity in the company, and that if they have a solid thesis in terms of what they're taking that investment and what they're going to do with it, and they're able to perform at historical levels, then they're going to be able to make their investors very happy. They're going to be able to grow their business, and they were able to do it without passing through typical lenders. If we look at real estate, well, we went from small billions in blockchain startups to have access to intellectual property like patents. One of the things that you may want to do over time is to simply take those and package them into groups of patents, and those become very interesting assets that can be traded, that can be purchased, and there are plenty of people that work in this space. A lot of money to be made here. If we can tokenize those things, then again, fractional access, democratization of that, potentially liquidity. Those are all very interesting things, but more importantly, the ability for the person who owns the portfolio of patents, now they don't necessarily have to sell the portfolio in order to commercialize it. They can raise money through tokenization and provide a revenue share. If we look at other things in the IP space, people's excitement about brands and side as an investment. If we look at some of the pop culture, space, Mythic Markets, which is out of an asset, is going to open up investment opportunities and help digital $2 billion assets that can be traded, that can be purchased. If we look at other things in the IP space, people's excitement about brands and their interest in being fans of lots of things, a lot of this stuff, these things are very high performing assets over long periods of time. If you look at things like AVENGERS, notes to automatically take all of the funds or that are available, for example, in the revenue share, and distribute it fractionally to all of the token holders. Some of the risk, or when you have FX or intellectual property, legal expenses drive almost to zero, because expenses will be The reality is a tremendous amount where you spend a lot of time on this through tokenization for the person who owns the portfolio of patents. Now they don't necessarily have to sell the portfolio in order to commercialize it. They can raise money through tokenization and provide a revenue share. If we look at other things in the IP space, people's excitement about brands and their interest in being fans of lots of things, a lot of this stuff, these things are very high-performing assets over long periods of time. If you look at things like AVENGERS tokens, Harry Potter tokens, Beatles tokens, every time a new movie or a new book comes out, these things can make a lot of money historically because it drives interest towards the IP that's already existing. When it comes to music and songwriting, Michael Jackson's stake in the Beatles songwriting catalog is worth more than his own. Songwriting catalogs in terms of intellectual property are very interesting assets. Mona Lisa, well, I doubt the Louvre is going to sell her anytime soon, but when it comes to high value art, you could either do a revenue share because that art is creating revenue through, for example, museum access, or you could simply have kind of an equity version where you want to own part of a Picasso, but you don't happen to have a couple of $1 million in order to do that. So what if you tokenize that, then you could at least have a fractional ownership of those things. The idea here simply is by breaking all of these assets up into small pieces, by creating this democratized approach that then has, again, that secondary market liquidity because you'll be able to trade them. It allows people who are passionate about these subjects to be able to have to own something that they care about in terms of being a fan, but also potentially has very interesting upside as an investment. If we look at some of the pop culture space, Mythic Markets, which is a website, which is a platform that tokenizes investment into pop culture collectibles, they tokenized an Alpha Black Lotus Magic the Gathering card. This card was worth around $90,000, and 2,000 shares of the card were sold through this platform. They're currently doing the same thing for a Marvel comic that was the first appearance of Spider-Man, and that is $92,000 broken up across the shares. If we were to look into films, Ryan Cavanaugh, who is the producer behind Fast and the Furious and Social Network and around 200 other films, has $17 billion in box office revenues. He has tokenized a $100 million fund in order to make new films, and to do that through, again, this fractional access way that allows a lot of people who are not necessarily typical film investors to be able to participate in that, and will also then change the way that those funds are handled once revenue and profit is gained over time. Venture capital, private equity, this is getting very interesting, but it's really kind of at the beginning. Here's some logos of a bunch of different funds that are tokenizing. The idea is really on two levels. Can we reimagine how limited partners that invest into a fund are able to exit their investment, being able, instead of being locked into the full life of the fund's portfolio, which for early stage startups might be 7 to 10 years. Tokenization would allow a more evergreen approach where maybe those LPs can move out when they're happy, when they're satisfied with the returns that they have made. And then people who are still excited about the performance of those assets can move in, or maybe even more of an evergreen approach where the fund never actually closes out, continues to invest in other startups. And so this becomes more of a performance over time of how that fund does at picking new things and the success of that. So the last thing to look at here is just what will it take to continue moving forward with tokenization of all these different assets. The biggest issue is that we need innovation support of regulation and not regulation-lite. What I mean by that is there are a lot of jurisdictions who have tried to go light on KYC and AML or other things in order to make their jurisdictions attractive to tokenizing assets. The issue with that then is once those assets move towards a secondary market, you're potentially going to have markets like the US where the SEC is going to say that KYC and AML were not done in an appropriate manner, and so secondary trading might be blocked to Americans. I think that it really matters that regulation is done to a correct level and that we understand where the money is coming from, and that all of the appropriate concerns for KYC and AML are done correctly in terms of investment. However, we need those things to be innovation supportive and understanding that this is a new space and that we are going, there are a lot of questions that need to be dealt with in order to make this work, but that it can work as long as all the involved parties work hard to make it happen. So I think it's what we're seeing in a lot of places. We're seeing it in Singapore. We're seeing it across Europe, in Luxembourg, Switzerland, Estonia, Lithuania. We're even seeing lots of really cool things in France and Germany. So we're going to see even more of that. Last piece to look at here before we go, the U.S. Office of the Comptroller of the Currency, which is the applicable federal regulator in this instance, will allow all nationally chartered banks in the U.S. to provide custody services for crypto assets. That is new as of this week. That is extremely interesting. That kind of blows the door off of institutional custody in the United States, which means that all of these companies, all these financial advisories and different companies are going to start figuring out all kinds of ways to market cryptocurrencies and tokenized securities to their existing clients and really opening it up to Main Street investment. I think it's pretty cool. We are on our way. Thank you for joining me. Again, my name is Ethan Pierce. Please do connect with me on Twitter and LinkedIn and reach out if you have any questions or anything that I could potentially help you with, and enjoy the rest of the breakfast. Thanks.
All right. There we are. Can we hear me okay? All right. Yes, good. Sorry about that. I don't know what happened. Normally that's the foolproof way of of running one of these things, but somehow we fast forwarded past a bunch of things. Good news is I believe that this is available to you afterwards to be checking out. I'm also going to post here the YouTube version of that. It's not a published YouTube, but you can, if you click on it, you can watch it, so you can see the whole thing without any issues. So if you do want to watch the whole thing with some details, there you go. The biggest issue is that there are a lot of very interesting reasons why we are going to be applying tokenization to all of these real world assets. Like I mentioned, the democratization of this, a lot of people are not accredited investors. They are not necessarily institutional investors. And so by providing access to retail Main Street type investors to all of these assets, that's going to really be very, very, very interesting. A lot of the examples that I showed, although it clicked through many of them, on the real estate side, for example, are allowing people to get access into some pretty cool assets. So that democratization is going to become important. Right now, a lot of this stuff is still only available to accredited investors simply because the regulation is catching up. But that is going to change quickly as we move forward. We still want safeguards in place to protect retail investors from getting abused. But this is going to provide a way to get access there. And then the fractional ownership piece is really the one of the biggest reasons why tokenization is so useful. Just the simple fact that, you know, if we're looking at an apartment building that has 10 apartments in it, your minimum unit of investment is one apartment or one office. One piece of these assets. By breaking that up into 1,000 tokens, 10 million tokens, whatever the number is, it allows you then to get access based on the capital that you have. If we're looking at fine art, as you know, one of the examples, then if you wanted to invest in a Picasso, you might not have $50 million to invest in, but if you have 50,000 and they print and they issue a million tokens that relate to either an equity version of that asset, or if there's some way that asset is being commercialized or monetized as a revenue share, then either way, this would allow you to purchase a tokenized access to that asset relative to the amount of capital that you have. So anyways, there's that idea of fractional ownership is really the big deal. In terms of the liquidity, that's going to be very interesting. But right now, this is about primary issuance because we're really getting still the a lot of the regulatory issues out of the way. But once we get past that, we'll see more and more interesting places in terms of liquidity. And then and just in terms of the examples, this is really everything you could think of as an that is an asset, whether it is a fungible asset or a non-fungible asset, meaning whether it is unique or non-unique. So if it's a unique thing, like an apartment or like a piece of art or a patent, or potentially even things like you saw the trading cards or the comics, all of these different things. Those are unique assets. If we're looking at potentially non-unique commodities, this can still work as well and is being done. But you know, whether it's a barrel of oil or a certain amount of corn or things like that. But the idea is allows us to replace these trust authorities that we historically have used the stock markets or other things with an automated version, because we can trust the blockchain. You might not know a lot about the blockchain, because I know this is a Forex breakfast, so maybe the blockchain is something that's new to you. Crypto is new to you. The issue is pretty simple. The idea is pretty simple. The blockchain is a digital ledger that's automated and that uses cryptography to make sure that it can't be manipulated. We're not going to go into a blockchain course, but the idea is simple. With all of these things in tokenized securities, we're able to replace or at least automate the historical trust authorities with technology that is statistically much more trustworthy than the humans that are doing a lot of this. Like, errors happen, mistakes happen, but it also means that they can be much faster. Because of the automation, and we can do lots of simple things, like instead of having to deal with paying out dividends by going through and manually looking at each person and using potentially software to do that, but having to manage that and having settlement times, the smart contract, which is a way to program the blockchain, just basically says, well, okay, well, we're distributing $2 million worth of dividends to all the people who own tokens. You own 3 of the tokens, which is 0.01% of the token, pool or whatever. So instantly we're able to transfer that amount out through the smart contract, and all of that done in an automated way. That's just, kind of the talk about all the different pieces. There's lots of reasons that this is happening, and is happening a ton. The people who are getting most excited about this are not crypto people, not blockchain people, not even startup people. The people who are getting excited are the people who already invest in real estate, so they see this as a new way. The people who already invest in patents, so they see this as a new thing. The film funds, where they're thinking, I already do film funds, but this is a more efficient way to do it. So that's why this is gaining a lot of traction, and where it's going from there. If you have any questions about any of this kind of stuff, feel free to check out the full version of that keynote. And I very much look forward to any of your questions. Connect with me on Twitter and LinkedIn. I posted the links above. And enjoy the rest of your breakfast today. Thanks.
Hey guys, once again, just making sure that my mic works again.
G'day. Can you hear me and everything okay?
All right. So okay, guys. Thank you very much for the sharing session from Ethan. It's really insightful. I think it's a really insightful presentation to tokenized securities. But anyway, moving on. I would like to welcome Ricardo Evangelista from Active Trades, along with Thomas Kuhn, who is research and trading at Mind Digital, along with a global macro analyst at Quantum Economics, right? So they'll be discussing, they'll be having an interactive chat and a live question and answer session on managing risk. So I'd like to encourage everyone, right? I'd like to encourage everyone to continue to use the chat, continue to use the questions function to ask these two amazingly bright minds questions. Over to you guys.
Ricardo, I think we've got you on mute there still. While he's doing that, guys, welcome everybody. I'm over in Australia, so as you can probably see, it's nighttime. It's our evening. So if you do see me grab a sip of wine, it's not breakfast wine. How you going, Ricardo? It looks like you're still on mute there. Might be having a few. So we're going to have a bit of a chat about managing risk and the macroeconomic risks that are around at the moment. I've got a few things to chat about. All right, guys, I might just take it away. So of the risks that we're sort of perceiving in the markets at the moment, obviously it's a bit of a crazy time. There's a lot going on with the coronavirus, with the policy responses to coronavirus have been very dramatic, as we all know. There's questions around the currencies at the moment, especially the US dollar. There's a lot going on in the yuan. And there's all kinds of unusual risks. A lot of people thought the US dollar was going to start appreciating after the coronavirus with this emerging market debt that was outstanding, and instead the US dollar started coming off.
Okay, I think hopefully you can hear me now.
Ricardo, how you going?
Right. Okay. Well, sorry for the technical hiccup there. I did test it earlier and it worked. So my name is Ricardo Evangelista. I'm a senior market analyst at Active Trades. I have more than 10 years experience in the markets. And today I'll be joined by Thomas. He already introduced himself. So we planned on having a conversation that will be focused on the state of the affairs in the financial markets and the potential risks emanating from this state of the affairs and the way these risks could impact traders, but also brokers, of course. We are living through very interesting times. The coronavirus and the lockdowns that were imposed as a result of it all over the world created the largest economic contraction during this time in living memory. Hundreds of millions lost their jobs or were furloughed or forced to work from home, and governments and central banks were forced to adopt unprecedented stimulus measures. At the same time, as if this wasn't enough, we are also witnessing a constant rise in the tensions between the two main global economies, so the US and China. And it does, to some extent, feel a little bit like we are coming to the end of an era. So the globalized world that we became accustomed to seems to be ending. The climate is increasingly polarized with two main blocks, and the conflict that started more in the sphere of trade is now expanded to tech as well, and also within the geopolitical sphere we can see that there is growing tension. There's a situation in the South China Sea. There's a situation we've seen recently in the border with India. So we are definitely living through very interesting times. Interestingly, at this time, the levels of debt are going through the roof, and it does feel almost like the US and China are also competing to see which nation becomes the most indebted nation, which one can claim that title. Tom, I've been talking a lot. I mean, what are your thoughts on this? How do you view the situation, and what, in your opinion, could be the repercussions and impact?
Yeah, it was a good intro, Ricardo, of the top-down picture. I think there's a few moving parts there at the moment, and a lot of them do sort of work in with each other. Where you've got on the political front, you've got the US and China, who are both who we've got obviously the US dollar as the incumbent currency, and you've got China developing their digital yuan. There's the sort of stories about China getting as much gold as possible. There's sort of rumors that maybe the digital yuan will be gold backed, which would be a very, very interesting development if it happened. And there's all kind of sort of risks around that as well. I think that the Chinese financial system itself is in an interesting situation where they've taken they've taken liberties with the levels of debt that they're currently sustaining, which is 300% to 400% of GDP. Although obviously these figures are not fully known. There was record new debt taken on in Q1, so they're really ramping that up as well. Their GDP figures started to look a little bit too smooth around 7 years ago, so I think that the curve is too smooth for those numbers to be accurate. Last year they opened up to foreign capital, which is also a little bit surprising. They'd sort of rebuffed having open markets and open capital markets, and that could perhaps be a sign that they're seeing trouble themselves. Non-performing loans are increasing, so their non-performing loan rate at the moment is about the same rate as Australia's was during the GFC. And that's also an official figure, so we're not sure if that figure is larger than what's being reported. On top of that, we've got, like you said, the end of globalization. So perhaps there's less cash flow going through China. There's manufacturing moving to other countries. And I've always thought there was this interesting phenomenon with China, where they were sort of a tiger economy. They got a lot of capital coming in, and they've sort of evolved into something else that's not quite familiar, that people don't know what it is. And then on the other side, I guess we've got the good old USA, who are doing what the USA does. Ricardo?
Yes. No, it's interesting. It's interesting that China, if we look at the progress made by China, so, I mean, if we think that in 1990, 9 out of 10 people in China lived below the poverty line, and today there is less than 10%. I mean, this is one of the greatest governing achievements in history, surely, but it's also a manifestation of the Chinese increasing will to become a world power, not just an economic tiger in Asia. I mean, and if we look at the long term for China, it essentially entails that by 2049, China aims to be the leading global power in every single field, including militarily. So you can see why this is raising some concerns in Washington, and why this geostrategic horizon is contributing to the tension that we're now seeing building up on the trade front, on the tech front, and also in regional conflicts. But I would actually take this chance to move on to a slightly different topic, which is also has the potential to be a significant risk event. And I'm talking, of course, about the discrepancy between the performance of the real economy and the performance of the financial markets. I mean, the discrepancy is enormous. As I said during the introduction, we are now witnessing massive economic contractions all over the world, in the US, in Europe, everywhere. And it looks like there's a second wave, or there may be a second wave of the coronavirus coming along. So this will further slow down the progress of the economic recovery. It's very unlikely that we will end with a result that was the best case scenario at the onset of the crisis, which was the V-shaped recovery. It's very, very unlikely. So one would think that there would be a reflection of this state of the affairs in the financial markets, but actually it's almost like it's a reflection. It's like an iPhone reflection. It's exactly the opposite. Financial markets are doing extremely well, especially stocks. And we're seeing that the Nasdaq, for example, hit an all-time high during this crisis. Also, the S&P is back. All the major indices really are all back. But interestingly, gold is also going up, which is unusual. So gold going up during a bull market in the stocks. It's a little bit unusual. So this could mean that investors are hedging this risk. What are your thoughts on it, Tom?
Yeah, I think that is an interesting phenomenon, where after the global financial crisis in 2008, a lot of people thought that inflation was going to come along and that gold would be the trade. And then after that started to resolve itself, gold actually came off, although I guess it had also had quite an impressive run. And one of the things that I wonder is if, because the US dollar still had a reasonable interest rate, that it was still sort of considered a store of value, that you could hold your money in fixed interest US dollar products without losing value. And now that US dollar fixed interest products are approaching 0% and even negative yields in some cases, that I wonder if it's no longer being recognized as a store of value. It's no longer being recognized as money. And then as the sort of cornerstone of the global financial system, if the US dollar is with that lost status, is even potentially being replaced in some respect. or could potentially start to head in that direction. And I'm sort of aware that that's a big statement, and gold is not really ready to play that role. But what I'd noticed in markets is that as a reference rate for assets, so if we so the reference rate being the asset that we use to price another asset, so most of the time it's US dollars, say the S&P 500 in US dollars. I've noticed that if we price the markets in gold, so the S&P 500 in gold, that trading decisions are much more rational, and the expectations that you have from the economic data start to become reflected in the S&P 500 in gold market. And that's something that I've found very, very interesting. And I wonder if as people see that and realize that their investments are more rationalized by making them priced in gold, that perhaps gold sneaks in as a sort of de facto standard. Because if we started to see that, say, in these US dollar fixed interest products, then future US dollar flows could even be priced in gold with forward contracts and futures contracts. And there's sort of this sneaky way for it to creep in, and I find that very interesting.
So are we talking about the return of the gold standard?
Well, if this is the big question, because what the question that I find really interesting is if US dollar fixed interest products start to be hedged, the US dollar component in gold, and from what I've seen in some of the charts, it looks like it makes sense. Then is that a de facto gold standard?
It's not. Technically, it's not. But in practical terms, the end result, it amounts to it, I would say.
Yeah.
I mean, we are not there yet, but it's very interesting. It's very interesting to see the rise of gold. Of course, a couple of days ago, it hit an all-time high. And very, very close to $2,000 per troy ounce now. So this is a very significant point we're at for the price of gold. It could also mean that we will be looking at a more generalized interest from investors towards metals. We've seen that silver as well is also rising, and this, of course, creates an entire new dynamic in the markets, as you were very eloquently explaining there. And if we start pricing assets in gold instead of US dollars, then we look at the price action, and it appears a little bit more rational than it does in dollars. Absolutely. But moving on to another topic. I would like you are in Australia, of course. And a currency that I've always been interested in is the Australian dollar, and obviously it's a risk related. Yes, absolutely. So it's a risk related currency. The Australian economy is strongly linked to the Chinese economy. I mean, how do you see the Australian dollar's outlook? Obviously, this is not advice, and this is in no way or shape advice from our party. It's just a conversation we're having. But how do you see the outlook for the Australian dollar, considering where we're at the moment?
Yeah, so I do a weekly newsletter, and back in around April, I had to sort of think about some of the policy responses that we were seeing around the world, and obviously there was quite aggressive monetary responses. And then I'd started to have a think about the fiscal responses as well. And we haven't seen the official fiscal response out of the US. Being that I'm personally expecting, I think the market is an infrastructure spend, and China's already done that. So I think for the Australian dollar, that if these kind of fiscal responses come out of China and the US, that we start to see a lot of interesting commodities. I think maybe about 3 weeks ago, commodities had kind of been bid, and it looks like it was inflation creeping in. And the last couple of weeks, it's not been as obvious or as definite, but it's sort of got that potential in there with this fiscal expenditure in the US and in China. So my view on the Aussie has been that I think that we're probably in an uptrend. I think we're probably rallying. right up until we see those announcements by the US, and we sort of see that play out. And I'm even expecting the Aussie dollar to rally all the way into some kind of response from the Australian government, where it actually has become sort of got out of hand. So that might be in 6 months or 12 months, and sort of a long-term view. But I don't see what holds it up, especially with US dollar weakness.
Okay, well, I think we are coming to the end of our allocated time here. So
Okay.
it's been really interesting and nice chatting to you, Tom. So I will take this opportunity to say goodbye. So thank you very much for the invitation once again, and for watching. And I look forward to the next one.
Cheers. Thank you. Should we take a look at some of these questions? Sorry, guys. We'll.
Thank you very much, guys. It was a good session.
Hello?
Good morning.
Morning. Can you
Hi, good morning. Hi, good morning. Can you hear me?
Yes.
Perfect. I think we. How's it going?
Hi, Robbie.
I think we have everyone joining right now. As mentioned in the agenda, we want to talk a little bit about sales strategies in light of COVID, work from home, and sort of talk to a good group here around sort of what folks can do to be successful as part of the sales strategy. So obviously we have a big group here, so just in sort of 10, 20 seconds, if we can just all go around, give a brief background, and then we'll kick off the discussion. I don't know, Ian, if you want to start.
Hi there. Yes. Hi. Good morning. Morning, everyone. So excuse there might be a few noises in the background. So I Ian Daniels. I look after EFX distribution for Europe and the Americas at Nomura. I've been here for a couple of years now. Previously, I was at NatWest RBS for about 20 years, so in various FX roles. So I've seen a few things over the past over that time.
Ria, if you're trying to speak, we can't hear you. I don't know if you're on mute. Natalia, maybe you want to just give a brief intro. We can.
Sure. Hi, everyone. My name is Natalia Hunik. I'm a Chief Revenue Officer at Advanced Markets Group. I'm responsible for our organization's revenue growth, including strategic market and sales and commercial operations. Advanced Markets is a true prime of prime, an institutional liquidity provider. We're licensed by ASIC in Australia and UK FCA, and operating globally.
Perfect. We still can't hear you if you're trying to talk, Ria. You may want to restart a browser. I guess there were some issues with and log back in. Paul, I guess.
Hi, yes, good morning. My name is Paul Arnold. I'm the European Head of Sales at Euronext FX, which was previously known as FastMatch. Been there for about 18 months. Previously, I've been in the business for about 22 years in the FX business. Started my career at a company called HYPERION as a co-founder, and then spent the last 9 years at Bloomberg in various FX and multi-asset roles, but ended eventually as the European Head of Sales for FX Go.
Thank you. Perfect. And then Robert.
Hey guys, good morning. Robbie Sibrandi. I'm with Flow Traders. I've been in FX nearly Paul, about 20 years. I can see some hairline with Ian Daniels. I think he's about the same time in. So we're a few old guys here, but I made my way into the tech space a few years ago. I'm with Flow Traders now. Flow Traders is Europe's largest ETF market maker. Obviously, passive investment has taken a huge flight over the last decade. Yeah, it's become quite a big business. What I've been doing at Flow Traders is building the FX business. We're a non-bank liquidity provider, as you say these days. We're a principal trading house, so not a broker. And we obviously use all the flow we get from the ETF business to kind of as a core inventory to market make into the street. And, you know, we've very successfully built this out in the last 3 years. We've actually exponentially grown in the last 6 months. And yeah, we're looking forward to this panel and see, you know, where everyone's at in this COVID situation.
Perfect. Thank you. Ria? No. While Ria's sort of, let's see what we can work out here. David Streiger, I'm a principal consultant at Grant Associates. We're a financial data analytics provider to the industry. Work with a number of banks and broker dealers, buy side accounts here in the U.S. and oversee our U.S. FIC research practice. So maybe Ian, just for you quickly, you know, according to our data, about 80 to 90% of all FX volume is executed electronically. Obviously, it's the most electronic market out there. Anecdotally, though, we've heard, at least during the COVID crisis, many clients actually wanted to speak to their sales team more on the phone. Can you talk a little bit about how your e-sales team partnered with the broader organization during March, April?
Yeah, I think, I mean, for me, you know, regardless of the situation, I think, you know, and here at Nomura, EFX still requires a human touch. So for us, we're more than happy to service our clients however they wanted to interact with us. Internally, we have the group chats, WebEx rooms, you know, streaming WebEx rooms that are there constantly, and old-fashioned phone calls to keep the lines of communication open. So I think to a degree, obviously things are very different. That's certain, and I'm sure we all agree with that. But I think for me, EFX doesn't totally replace the human touch, and I think, you know, although we're further physically apart from our clients, and to a degree, the crisis gave us reasons to call them, ensure we know how they were doing, whether they needed us for just the basic things or any sort of value-added interactions. And I think, you know, this has been a subject that's been written about. Actually, I saw this morning on BBC that everything, you know, everyone had a sense of connection when this crisis happened, and sort of we're all in this together attitude. And I think that prevailed both internally and externally. You know, whenever we reached out to a client, the first thing you talked about is what's the situation like where you are, right? So it gave you that sense of connection. I think, you know, that apart, I do personally, you know, you said the anecdotal thing about wanting to speak to people. I think people did want to speak to people, but actually the audit trails that are available when you execute electronically, for me, lent themselves to an increase in electronic trading. And, you know, we've spoken to a few buy-side guys, and actually their electronic trading volume gone up. So we felt for actual execution, people relied on platforms more than they did before. You know, and again, if you look at some of the articles, and certainly what we've experienced on the algo side, there's been an increased growth there. The spreads widened, people started to, rather than bring up the risk transfer price, actually started to put more into algos and sort of used passive or pegged algos to capture spread, and that was feedback we received from a lot of real money guys. So I do think, for me, actually in terms of execution, there was more execution done electronically, especially with people working from home, not able to get hold of people as quickly as they wanted on the phone, and actually the electronic methods worked very well.
Got it. Yeah, I mean, I think to your point, it was new for this crisis was new for everyone. So, you know, no one really, everyone was, to your point of everyone being in it together. I think it was an interesting time, you know, for everyone, and no level of experience or seniority in the market really could prepare anyone for this, and it was obviously a shock, and given the remote disruption, clearly was a unique time that probably will have lasting impact on the work environment, etc. And Paul, from our discussions with the buy side, everyone was pretty much very impressed with how well the sell side handled the transition to remote environment. Can you talk a little about market infrastructure areas you think held up well, learnings from the period that may drive improvements in the market structure moving forward? Paul, you're still. Oh. Did you hear the question, Paul?
I did. Sorry, apologies. I was still on mute. I suppose, from our perspective, being an ECN, but we service both buy side and sell side clients. So we kind of see what's happening on both sides of the fence. I think what we did see, clearly was a lot of the sort of less tech-based or tech-savvy sell side firms, sort of as soon as the volatility started to hit in mid-March, that they stepped back from pricing aggressively, and you saw more of the tech advanced, the superior tech type sell side firms sort of step in and become much more aggressive in terms of their pricing and in terms of how they attack the market. I think for us, one thing that was sort of noticeable as an ECN was prior to the lockdown, and I think over the last sort of couple of years, the narrative about ECNs and about anonymous trades has been about how the market is going to move towards a more firm pricing, how the market is moving towards more disclosed trading than anonymous. But I think what we did notice during this time of high volatility, which is probably something that happens across all volatile times, is that we noticed that actually a move towards more anonymous trading and more towards the sweepable markets. So I think for us, one of the things that we've learned is, I actually recently did an article in eForex, and it was about have we underestimated the growth potential of anonymous ECNs. I think what that gave us during that period of immense volatility, and certainly for me, who's relatively new to the ECN space, coming from a GUI-based platform like Bloomberg, is that there is absolute room for anonymous ECNs and sweepable ECNs, and I think it kind of, for us, changed that or certainly rubber stamped the narrative about, there is no two ways about it. The market is definitely looking at more disclosed avenues and definitely looking at more firm prices, but it hasn't ended for sweepable markets and for anonymous trading. So it gave us an immense amount of confidence that what we're doing, being an ECN that services both firm disclosed and sweepable anonymous, means that we are doing the right thing.
Got it. Good. Anyone else? Any thoughts on sort of learnings? I know everyone has a very unique perspective here. So any other thoughts on learnings from this period that can help sort of drive market structure changes moving forward?
Yeah, if I could take just a second.
Yeah.
Look, I agree a lot with a lot of things Paul said. We use this ECN, of course, as well, actively. I think look, when the crisis hit, everyone was kind of, as you say, we're all in this together. Everyone had to work from home, adapt. We're doing these kind of things where normally half the people wouldn't even show up and listen to any of the talks because you're there for the networking. Now we're all of a sudden kind of a bit more back to content, which is good, sharing information. On the market structure, I think, for example, we're a non-bank liquidity provider. What we saw a lot is that some of the larger guys that we have only fairly recently been starting to quote, because I think for a while the discussion was a bit about, again, banks, non-banks, how all that went. But what I see now is that quite a few of the probably established names didn't show up in the same way in the crisis as they used to show up. I also think the value add of calling your trader who's now sitting at home instead of a dealing room and then working your order is just not the same. So a lot of that kind of trading has switched to the E levels, the algos, but also stuff that people built in house. So it feels to me, and there's also a big infrastructure on, right? The way that Citibank is saying, look, we're only going to focus on 5 because there's too much infrastructure. Some people like the competition of the infrastructure. From us, we're a tech fund, right? We're fintech. Out of the 350 people, I guess that we have in Europe, 200 are in IT and development. So we kind of thrive in these situations, right? Because we have the spend that we can do on infrastructure. We have connectivity, algo building. We don't have kind of the real franchise in the sense that banks and other people have, where you actually go from small cap, mid cap, large cap, retail, all that. So we don't really compete in that way. So we also see that a lot of those banks are looking more and more to the likes of us, to offload the risk and get a price, and they actually focus more and more on kind of the salesy bit, I think, right? So I think there's an increased focus from trading to sales within some parts of the world. And for us, we just happy to connect and, be in it for the tiniest bit of spread and let other people have their own franchise. And I think, for us, but I do think the last thing then with Paul, the market does move a little bit more back now that it does settle towards disclosed trading. And also we see a big pickup in full amount, right? I think now the only challenge for us is to explain to everyone that full amount is also to be traded in a certain way, because we can stream you in 20 and 30, but there is certain behavior that comes with those type prices you get, and that is still and will probably forever remain the challenge, of us versus the people that we price.
Got it. And then just Robert, just want to sort of building on some of the previous discussion. Obviously, lots of changes going on in the market. Most folks saying, things were positive. What do you think is going to continue once things return to normal from a sort of remote working, obviously continuing to grow, other things you sort of see outlasting the crisis and becoming the new normal?
I mean, remote working for sure. I'm not going to tell you where I am right now. No, but I'm kidding. But remote working is, it was already a big thing. We have so many, and I guess especially in as an IT firm, as a tech firm, a lot of stuff can be done remote, and we see that now. We have to prove it. I think our management, to be honest, struggled quite a bit with the concept, and I think they're slowly but very surely coming around to, even when it does settles. We had a discussion about, well, at least 1 day a week. And people were up in rage about it, like it's all working. Why 1 day a week? And now they're like, no, but that was the pilots. We're going to do more days. So tech firms, and I think we're considered one. Google's already told their people to work from home until July next year, right? Well, after that, this means people will leave the city, right? If you know that already for a year, you kill your rent, you rent somewhere nice where you have a view and a different price. And this should be, I think, the way that it is going forward, right? So yeah, for sure, that is, I think, the biggest change really, I think, is the remote working and the way how you start monitoring your people and rewarding your people for this. But also, obviously tech spend. Look, we you see it with the big 5 tech firms and with everything around it, a lot more, it's the end of retail. It's all, Amazon and shopping. Same thing for us. I think, for us to just connect to everyone and show the price, it's a business model that's going to work. And I think if you have a lot of extra cost that some of the incumbents have, that obviously, if you're regulated as a market maker and not as a bank, you have for us, we will be getting more competitive. So we thrive on this, and we thought this would have happened before anyway. Interesting times, really interesting.
I think just if you don't, I was just going to say, I think you mentioned sort of the working from home thing. I think it's amazing how really have considered in the sort of sell side banks, front office, people working from home and it actually working and people being happy of it. If you roll back even to the beginning of the year, and that's different now. And I think that the chance, a day here and there, if you're traveling, in the sales roles that you have, hopefully we will be traveling again at some point soon, but to see our clients, and if you're going in to you don't have to go into the office before or after you travel, thing like that, because people know that you can work from home properly. Those type of things. You're not driven to go in the office at those times. That said, I think I've been coming in a couple of days, and you realise you do actually miss the interaction with people. You do actually miss being able to just turn around and say something, or turn around and shout something as you do over the board, over the screens, and that. We've been able to got some stuff done a lot more quickly. The other thing I was just, that sort of was apparent to us was the disaster recovery piece, and a bit of, I guess, boring subject, but the plans that were in place before that, so you had to change quickly, and then it makes you start to consider, do you need certain disaster recovery sites, and can you reduce that spend by sending, having disaster people assigned to disaster recovery, but having all the kit at home when you know it works, so that there's some savings can be made there. I think that's something certainly that people are going to look at.
I think from my perspective, we do have to remember, though, that working from home during a global pandemic, when everybody is working from home and everybody is in the same boat, is significantly different to, having members of staff working at home at various different times and some people being in the office and something out. So I think it does have to be measured and it does have to be looked at. But certainly I think it's definitely something that we are going to be looking at some point, and how we manage that going forward. One of the key things I think I've felt over what I've learned over this period is, using these technologies like we're using now, but Teams and things like that, has made us have much better, more globalized sales meetings. I think previously we have a global sales force in New York and in Asia. And I think previously we didn't have many global meetings with our clients. I think what we did previously was you'd have a meeting in London with a particular client. They would have a meeting with the Asia office. What we're doing now is it's forced us to have more globalized conversations via the mediums of such things like Teams and Zoom, etc. And I think that is something that we definitely be taking further as we go, as we move further out of this pandemic, hopefully.
And then Natalia, so what do you see from it? Yeah, we talked a little bit about technology. Sort of, how do you sort of see the next sort of year, 2 years, but also sort of out and from a technology perspective, in terms of tech priorities, to help make everything more efficient moving forward? Do you think it'll be sort of here? Like, do you think the technology investments folks are planning to make are sort of, just to address the near-term crisis, or do you think it actually sort of shifted priorities for the long term?
I think a lot of people already spoke to technology and evolution and changes, but obviously from the buy side, what I see is happening, and generally through a lot of organizations, is more agility. The crisis has called for all sorts of measures to be taken in place, put in place, and we saw organizations changing their priorities. We saw organizations changing their roadmaps, product development roadmaps in a matter of a day, in a matter of a week. I think everyone became more agile, more nimble, and I hope that actually this will stay, and we won't go to the same static ways of the planned like half a year, 1 year roadmap. From the buy side, I think we also seen that as a market phenomenon with Robinhood and all the other investment platforms, is the ease of onboarding. I think this is here to stay. I think a lot of firms are working towards making this process smoother, onboarding process I'm talking about, easier for the customer. This is certainly a priority for many. And from the sales side, I think a gentleman already spoke to interconnectivity. Certainly, as the volatility surged across the markets, we've seen that from our customers. So we saw a lot of need to add more liquidity where some certain liquidity providers fell short of the expectations. We needed to quickly find more venues, connect to more ECNs to cater to different needs. And advanced markets being the prime of prime, we service quite a diverse range of customers, starting from professional traders, algo traders, and on the other side of the spectrum, you have regional banks that connect to you over various ECNs, and sometimes you have a mixture, 3-5 venues that you're pricing them on. So this interconnectivity is really important. I mean, for our firm as well, we were able to connect to a lot more venues over the past 3 months than ever before, and this is all driven by customer demand. As it's been already voiced, a lot of people are trying to execute more trading electronically, looking at different platforms, not just one. Everyone wants a mixture, and everyone has different needs, whether it's full order execution or sweep-in or something else. So I think certainly more diverse technology environment moving forward.
Great. And then just lastly, I know obviously technology you mentioned made the onboarding process easier for anyone sort of engaging with new clients during the pandemic and remote working. Obviously, for someone who you're trying to onboard, there's obviously the technology, and then there's also the relationship, getting comfortable with trading with someone you've never met. Sort of for anyone on the panel, sort of have you dealt with those challenges? Have you faced them? You know, obviously it's probably harder, but do you think clients are open to that? Sort of anyone have any sort of anecdotes, experience, or wants to talk a little bit about that?
Yeah, I can definitely speak to that because I manage the global sales team. Yep. And it was, you know, even before the pandemic, even internally, we would have meetings without the video. And I said, you know, look, we have to start to change internally, and everyone has to go on the video during the internal calls. Of course, it's you know, much easier when you meet in person. And I think in the industry, you know, there was a bit of a challenge because of the old ways of doing things, you know, especially for you guys in Europe, meeting at the pub, you know, so those things had to change. And it was difficult for so many people. Not everyone is digitally born, right? And customers, the same story. So, but at the end of the day, as already been said, we're in the same boat. So we all have to, and we all have to embrace this, you know, new digital way of doing business. And you know, perhaps it takes a little bit more effort and a little bit more time. But I mean, I know in our organization, the number of Zoom meetings, I mean, since the crisis started, like shot up 200-something+%. So everyone had to adapt. Same goes with the customers. And until there's such time when we're, you know, we can obviously supplement this digital experience with in-person and travel, and you know, everyone has to embrace it.
Perfect. Thank you very much. Thank you very much, guys. I think we're up on time. So appreciate your time this morning, and it was a good discussion. And thanks very much for everyone joining.
Thank you.
Thank you
very much.
Thanks a lot. Bye-bye.
Bye. I think I'm staying for the next one.
Hello again.
Hello.
Hello, everybody. Good morning.
Hi, morning.
Afternoon or good evening, wherever you are.
I'm in Boston. So it's like 5 a.m.
You're amazing. You're amazing. Thank you for joining us, which means you
well, I had like 3 cups
earlier.
of coffee. I had 3 cups of coffee and still going there. So.
You're getting Starbucks vouchers. Right, I think we've got everybody here now. Let's kick it off. This is the marketing panel. Welcome, everybody. Just a very quick introduction on who is joining us today. We've got Natalia, who you've seen out of this fantastic sales panel that we just had. Natalia Hunnick, she is from Advanced Markets, CRO. We have Christos from iSpiral. Hi, hello, Christos. Thank you for joining us again. And we have Itai from Inbound Junction and a mentor of 500 startups. And of course, our very own chairman, Desmond Leong, who is a multi-talented Everest Fortune Group at the Forex Army and a technical trader analyst at AxiTrader, I believe. Is that right? Yeah, excellent. And I'd just like to say, Desmond, you get the award for the best microphone in the room.
Yeah. Unless you forget to unmute it, right? Which I
did. Right, okay. Let's start off with a question out to everybody. What specific marketing changes have you seen since the lockdown? Let's go very quickly around the room if you've got something to add to it, something very specific that you've seen in marketing departments or you've experienced or you've done yourselves.
Well, I could say that for me, I'm more on the PR and marketing end. I see everyone's kind of looking to see what they can announce. Everyone's feeling like it's a time to shine out and try to get into the news cycle, and it's a very good place where people are trying to find their cards, take their bets, and I see everyone going to their tech departments and business development departments and see what can we announce, what do we have, let's try and get in the news cycle.
Okay, that's exciting. Excellent. Natalia, Advanced Markets, you work with a lot of brokers. What changes or pivots are you seeing brokers making, particularly in their marketing? Are you seeing any?
Yes, well, certainly. I think, obviously, since we're in the global pandemic, I mean, I've personally seen a lot of messages on social media from various brokers, and they're trying to present the messages with, a lot more empathy, because, obviously we have, a lot of people feeling vulnerable right now. So I think marketing is becoming more empathetic, which is, I think, is a good thing, right? Because everyone understands that the clients are also, clients are globally, everywhere. And depending on where they are in the world, the situation may be worse, in some places than others. And so that's important. And I've seen that definitely happening with the brokerage houses. But I also seen that, they're using media in more agile ways. Definitely a lot of different mixture of, social media channels and a lot of digital content. I've seen webinars, I've seen live debates, all of that is obviously to create more engagement with their clients, as the personal interaction is very limited at this time. Going back to the point number one about the empathy, I think, from the more marketing / sales perspective, there's been a lot of, even from the larger banks, following on that theme, a lot of offers of, free checking accounts, and the same with the broker side. So at the advanced markets, where, for example, we waived the minimum monthly fee on accounts for the next 3 months. So I have seen that being done in other places as well.
I have to admit, I've seen that as well across the board, also with insurance companies giving people discounts off their cars because they're not going to be on the roads as much.
Exactly.
And I think that's resonated very well with your audiences.
Right. It's showing care. Yeah, showing care.
Yeah. I mean, we're all in it together, right? Christos, so regulatory risk mitigation for brokers. Tell us some of the interesting stories that you've had to deal with in terms of social media or affiliates dealing with, having to deal with some of the campaigns they've been putting out.
You will get surprised on what affiliates are posting within their accounts. We've seen several things, from driving expensive cars to having in front of their computers 500 euro bills, even nudity. Within their posting. So we've seen a lot of things throughout the time. But I think the important thing here is that the regulators are getting much stricter, and what Forex brokers should do, they should be able to investigate the affiliates even before they onboard them. So instead of going through manually and checking each account independently and seeing with a naked eye each image independently to see, the posting history of that affiliate, if they will be using, let's say, an automation, a technology that they can do that for them in a much more accurate way, they will be able to onboard compliant affiliates in a much faster pace. And this is very important for Forex brokers. There are different risks out there. The first risk is whether you're onboarding a compliant quality affiliate. And then from there on is whether that affiliate is compliant all the way. We've seen affiliates that they're just posting a non-compliant image, and then in a few hours they remove it. So you have a lot of risks.
Well, hands up who's ever used a money train in their past, if you've been in the industry long enough. Not me.
So it's amazing on what technology can do actually to minimize those risks, and at the same time maximizing the opportunities that you might have out there.
Right. And how do you maximize those opportunities?
I mean, you maximize the opportunities by onboarding more quality affiliates. So when you're onboarding, I mean, it usually takes a lot of time to onboard a quality affiliate because the compliance team has to go within their accounts, their existing accounts, to see what they have been posting so far. So imagine that you need to go all over the 1,000 images that he have already posted. And how much time does that takes you to do that with manually? So both on onboarding and on ongoing monitoring. I mean, you need technology to let's say maximize the performance of your compliance officers, but then at the same time maximizing the effort needed. I mean, as far as the marketing goes.
Sure. Now, let me just take a moment to draw people's attention to the polls. If you want to go over to the poll tab on the right of your screen, and you look at what is the best acquisition strategy for Forex brokers, have a look at that poll and participate. But continuing, Itai, where do you think Forex brokers are going to get the best bang for their money? I mean, budgets are tight, people have a lot of money, and there's been a lot of increased volumes in trading, but of course everyone's looking for the most efficient ways to get their marketing budget spent.
So my personal opinion, I think in today's time, where, as you guys said, there is no way for a social connection, is to actually think much smaller, where I would more go for like what's called social selling. So go to different places. It could be Reddit channels and conversations where people, it might be micro communities, might be very small people, but they're asking a lot of questions because there's a lot of instability in the markets right now. And by the way, there's also people want to say, it's not only, should I stay in Forex? Maybe go to Bitcoin right now, maybe go to gold, oil. Where is all this happening? And if you find those places and are able to give them kind of advice and all these different places. So that's where you can create those I think conversations again. It's not very scalable. So do affiliates at the same time where you go for I would say the longer kind of blanket of stuff, but try to insert yourself organically, being very clear who you are and not selling your service at the first point. So try to create those conversations, try to create some kind of a trust or value. And of course, when you're clear about who you are, there's a good chance they're going to come to you and say, hey, I'd love some help, or what do you think, or whatever. So again, not very scalable, but when done correctly by you or your employees or whatever, or even outsourced people, that could be a very, very effective channel, I think, in today's environment.
I completely agree with you, Ty. It's, we're seeing that also with micro influencers having a lot more engagement than, if you're going to pay out to, your big influencers who really just don't really care about your brand. So finding those kind of key, micro influencers that have a very tight but loyal following. I guess it's difficult for
see that person as a person that they would want advice from. So it's kind of tapping into whatever, but that person still. So I'm very for influencers, but my personal opinion about influencers, not only regulatory, it's also for the user, is to be transparent. It's not going to say, all right, I'll pay whatever. It's not even about being the nice guy. It's also the right sell. Because you want a guy who's seen as a legitimate person giving advice, and then if he uses your tool in the background or whatever, that's great. But so yes, influencers, but not through, I would say, hot girls on Instagram just holding a sun stream. We don't know why. So different kind of areas. I would put it that way, but I agree with you completely.
I guess it's very tough for brokers though to that whole community management is how do you. I know from my experience in over about 14 years in the Forex marketing departments, there's not a lot of marketing teams that will have that kind of community management. So do you look to maybe bring in some of your, support staff?
Yeah, well, again, so I want to be honest, I'm a marketing vendor and I work with a lot of, AvaTrades and eToros and plus 500s and all those. So, and we look at that. So of course I'm biased. I think there's a lot of things that, so if I look at like media buying, usually it's something that I believe you should have in house because it's you in front of, I would say, the machine, it's the algorithms, it's whatever. But let's say when it comes to more relationships and PRs and influencers, it's very hard to manage an operation where you talk to all these people daily and have something to give them. So that's where, again, being biased as an agency, I see a lot of value in taking agencies, and I'll add another part to it. I think that there's two things now that you should look at. It's just, again, this kind of community management, but also very important time to look at your digital footprint. So digital footprint is now, a lot of new people are getting into the game. They want to see, and they're going to look at all these things, but they are going to go and Google your name and see all these different reviews or whatever, and all these different things. Again, it's digital footprint is always important, but today when you see a lot of I would say noobs coming in, it's very, very important, because for them, they don't know that, oh, this site saying that guy's a scam is just an affiliate link trying to send him to someone else or whatever. They just see the name and scam, and they're like, oh, this person must be a scam. They're not aware of the traffic wars. So I would also try to look into that. And of course, I'm biased, but there's a lot of, I think, professionals and agencies that are out there that can help you in those situations, and doing it in-house from scratch right now on a tight budget when everyone's from home, it's a bit risky.
Yeah, I agree. I think that we've definitely been seeing a rise in scams during the pandemic. More people online, more people looking for ways to work online, and it's very, very tiring having to kind of go and do all that research and go, okay, this person that maybe wants to connect with me or wants to sell me something, who are they? How real are they?
Exactly.
But people are also becoming more aware of how to spot scams as well. So that's also a good thing.
No, I'm even saying that the whole internal wars inside this industry of other people trying to steal other people's traffic by just posting different things and calling that person out, so you'll come to my broker. Most new users don't know how to read between the marketing messages and understand that there's some kind of a pull and a play here. And you see a lot of illegitimate players just spending a lot of time trying to monetize on your personal brand. You are a broker, you're well respected, you put advertising, whatever, and then when someone Googles your name, the post number 3, 5, or 6, whatever, is some person accusing you of whatever. And again, a lot of these accusations might be true, but also a lot of them aren't there. They're kind of the marketing game now to track that user. So that's also just a very interesting thing that I see is becoming more apparent when you have a lot of new players that are not like, oh, that's a bullshit site that just is an affiliate site or whatever, that kind of stuff.
Right. Christos, is that something that you think your kind of platform could help brokers sort of find people that are mimicking them or pretending to be them?
I mean, my point here is the following. I mean, definitely. I mean, we're doing text mining and image analysis, and we can detect whether the postings that the users are making, they are compliant with the regulatory guidelines. We have also seen a lot of fake endorsements from celebrities, and this is something that we do as well. I mean, we analyze the photo, we see the faces that are within the photos, and we check them and we match them across celebrity databases. And this is something that the regulators are very strict as well, whether either the affiliates or the business that you partner with, they are posting fake endorsements of celebrities. And we've seen, I mean, lately some suspensions of licenses because of that. So again, technology is there. Technology can help you improve your regulatory, let's say, obligations. And at the same time, as I said before, you can use that to maximize the quality of the partners that you are bringing in.
Desmond, hello. And he's just gone off.
Hello.
Oh, you're on. Just leaving you back. So, we know that, okay, so I think listening to all this, one of the things that really stands out for me is the need for brands to be very strong in who they are. And as somebody who's a technical analyst and involved also in the marketing end of the business as well, is technical analysis something that, a lot of brokers bring in either through third parties or through customized analysis? What's your take on that? One versus the other. Well, what are clients looking for? What's bringing greater value to both the trader but also to the broker?
So I guess a lot of it revolves around ultimately the quality of analysis that is brought in, right? And some brokers might not have the maybe the budget to hire a full in-house team. I mean, there are some brokers that do that very well. I think just to mention a few names we see. I mean, XTrader does that, right? Hot Forex does that. You know, they really have their own in-house like star teams. And some brokers, you know, they're starting off smaller. They choose to go with something like Trading Central, Auto Chartist. But interestingly, right? I feel that, you know, in your previous conversation with Itai, right, is that if you're talking about the lines of influencers, right, the brokers can actually have their own little in-house influencers in the form of analysts, right? We see that across different brokers, right? Pepperstone has Chris Weston, right?
He did that amazingly with Matti Greenspan. They just really turned that person and going to be into a huge outlet for them.
Yeah, exactly. Right. It's so interesting, but there is a danger of that, of course.
Of course.
Like, you know, you build up this profile and the guy is like, oh, ideals, I'm going over, and you lose your.
I think that happened to FXCM about 10 years ago. They had a couple of analysts who were quite big superstars, and then they started asking for more money, and then another broker came and bought them. So there is that risk.
Yeah, that is the danger. And the thing about technical analysis, right? Brokers, how they're using it, how they're using it for, you know, acquisition, for volume generation, right? If you ask me, the current model they're using is actually pretty terrible, right? Honestly speaking, I mean, let's face it, right? And this is coming from an analyst, right? Every other broker is offering their own analysis reports. You know, why would a visitor come to your site? You know, they read the report and go like, wow, you know, this $0 report is amazing. I think I'll just open an account with the broker, right? Like, no. If you think about it, especially from a marketing perspective, let's face it, no one would do that, you know. And it's funny when we're looking at many of these many brokers, right? They are not wrong that, you know, analysis, you know, if you do it right, you know, with the right SEO, you could bring, you know, the latest hottest news. You can bring people to your site. You know, they can read a little bit about your site, but to link that to like client acquisition and volume generation is much, you know, it's not as simple. In fact, it might not work that well, right? Because maybe volume generation might work a little bit well. Like your clients read a little bit about it, right, and they get excited, they trade a bit. But if anything, if the last 3 months has taught us anything, right, is that volume generation is driven a lot more by the volatilities in the market, you know, the speculation, whatever Donald Trump tweets, right? It is driven a lot more by that than an analyst like so-called churning out reports, right? So I think, so without digressing too much, right? How can a broker, right? Many brokers have technical analysis. Many brokers have a market news page, a market blog page, right? How can, you know, using the concept of influencers, right? Do you want an influencer which you have no control over, which Itai mentioned, you know, pretty interestingly, right? Control is one of the key things that you look for, right? I mean, I feel that, you know, influencers in some way it will be very good, right? But there are some, you know, in many cases, it's very unlikely that, yes, a broker will hire their own in-house influencer team, right? It's very unlikely that they do that. It's probably better to get an agency to do that, right? But if you're talking about influencers,
by the way, it's also just because, you know, running tools. So again, views is something that's so, you know, easy to manipulate, and through just again, I'm not saying it's rocket science, but having the people that do the verification of, are these YouTube views even out there, or whatever, all these different things, and checking if all his Twitter followers are from countries where you're not active in and the broker doesn't speak that language. So there's a lot of different things that you should do, and not just like run and say, all right, this guy tweet per pay and let's run for it.
Yeah, we have actually just to pick up on that, we have a question from the attendees. You know, it's the transparency and relatability of micro influencers, and it makes them so much more effective. People are smart. By now they know that much larger influencers have paid for their endorsement. And how is that different from advertising? You touched on it before, Itai. So if you were working a team of people reaching out to influencers, what would be your kind of 3 things that you would tell them to look out for?
Sure. So first of all, I use well, if that certain person does a lot of slots that really recommend the exact same thing time after time after time. Now, it's more like if you're an athlete and you have, well, it's okay if you have a shoe deal and a closed deal, not 4 shoe deals. And it also shows about that kind of person. So again, if that person, I don't know what, is he has a relationship with a specific broker, then he talks about that specific platform. And again, he trades with that in the background, he shares your support. But if in the next episode or whatever, he literally mentions and plugs and talks about all the values and is trading from a different platform, then that just seems kind of disingenuous to me. And it just seems like just bad tactics in general. And another thing, again, I come from a very, I guess I work with maybe ones who are really going above the line, very specific about who they are, and maybe they have more money to do it. But it's more about what are the value propositions that you want to talk that you have and that are a bit more different. So I think that today, as you said, there's a lot of issues about volatility. So if the influencer is giving people advice that you as an analyst think is actually good advice, and it's good. But if it's just like, if you're connected to what that person actually his advice has to say, but go a few videos before and after it. If a week ago he said something that you think is fundamentally just errorly wrong, then you should look at that. So it's not that you're getting married to his brand, but at least make sure that he can play the plays that you want him to play and it makes sense.
Right. Well, I think we're kind of running out of time here, but I want to have a really quick roundup from all of you. Give me your quick, like 10-second answer, your top tip for maintaining high trading volumes or acquisition through your marketing in the months ahead.
I guess.
Natalia, shall we start with you?
Sure. Yeah.
Oh, sorry. No.
Itai or Natalia?
Natalia.
Sorry, I think we misheard. So the top tip to keep the volumes, right?
Keep volumes or acquisition, marketing activities for the months coming up and the way that the world's reshaped itself.
Right. Okay, so my perspective is more from the B2B side. And we've been doing that, and I know it's working. Is definitely engaging content, and we pride ourselves on putting out there not just any content. We're trying to put out very interesting content that is driven by data. So we constantly survey our customers and know what they're looking for, and we do a lot of research before we put out a piece of content out there. So from my perspective, it's definitely engaging and relevant content that comes with the valuable insights and valuable research that people can get for free. I mean, we're big on that. We give a lot of useful information for free, which builds a lot of loyalty with the prospective clients, because they appreciate the advice and the work that we have done, and it's obviously useful to whatever they're trying to do.
Excellent. Christos, over to you. Your top tip.
So my final point here is that technology can help both the compliance team and the marketing team to work together closely and help them acquire much more quality affiliates in much quicker time, and also help them throughout the phase of ongoing monitoring your affiliates and partners.
Right, thanks. Itai.
So for me, it's I think more about maybe increasing your offering, or maybe sometimes giving advice that isn't good for you in the short term, which is I call like don't get high off your own supply. Forex is one area, and there's a lot of areas and a lot of things are happening right now. So, or in your platform, or in your brokership, or in your ability, offer them the ability to maybe go into Bitcoin or go into gold or oil or all these different things, technically partnerships or whatever, or even sometimes do the weird thing of telling them, you know what, guys, maybe this is an interesting time to buy Bitcoin, or whatever, even if you don't offer that service. I know it sounds kind of surreal, but if you are seeing to them as their investment interest and not just Forex as an asset class, I think that that's a very good victory for the long term. And I would also always offer you to try and add more different types of assets that you can help them trade in at the same time.
Right, diversification. Desmond.
All right, I guess one of the big points that I want to encourage every broker, right, is to differentiate yourselves, right? Like you need to differentiate because every broker is a race to zero, low cost, fast execution. I got MT4, I got MT5, I got webinars, right? I got tutorials on how to do that, right? Every broker is the same, right? And I wouldn't say all the same, but everyone's competing on the same. There's only that much lower you can push price down, right? So how are you going to differentiate yourselves, right? There are people coming in for auto charties, trading central, these small little tools by the side. But if I'm really bringing it all back to that one point which I shared earlier, is that build a brand around your research team, your analysis team, right? Well, what I mean by that is that don't just give everything out for free, right? And this is one case which we're doing with one of our partners, right? One of our clients, right? What they did is very simple. They have a chief, a really smart guy. He's a chief market strategist, right? He used to be giving analysis out for free every single day, right? Just sending it out, right? And getting people to come into it. But how did you turn him from a free I wouldn't say a free resource, but a resource that just produce analysis? How do you turn him, an existing resource you have, to strategize him to be one of the biggest client acquisition and volume generation assets in your company? It's very simple, right? What they did was that they say, okay, everyone gets, a free access, just the basic access to this resource, right? If they register an account, they get a little bit more access, maybe access to an Elliott wave count on euro dollar, right? If they fund their account, they verify their account, suddenly, right, they get a coverage on gold and silver. Wish to speak to our in-house analysts, trade at least 10 lots, right? If you want to speak to the chief strategist, fund $50,000. Right, that is how you turn a resource that is sitting down there, right, into one of your biggest client acquisition resource. Because let's face it, your premium clients, right, do not wish to talk to customer support about the Elliott wave count of euro dollar. They want to talk to a guy who really knows his stuff, right? And many brokers are realized they don't know it, that the potential for the biggest influencers they have, the ones that can really attract, they're on Bloomberg, they're on Reuters, they're on CNA, the person that can really attract the attention and have that, and yet build the brand of the company are your in-house analysts, right? So really, if that's my biggest tip, is that try to not it's good to include more trading instruments, this and that, but look at what you have, in your existing pool of resources. Try to re-strategize that. And one thing I can say for sure is that many brokers, at least from what we're seeing, are starting to do that.
I agree with you. I think come and look at what you're good at and focus on that, and not try to do everything. Right, I think our time is up. Everybody, thank you for joining us. Do go over and check out the poll and the results of the poll on content, on the best acquisition strategy. Yay, Contentworks, because I'm into content marketing. That's what I do. I'm Niki, and thank you to everybody, Natalia, Itai, Desmond, and Christos for joining the marketing panel for the Big Forex Breakfast.
All right.
Over to you.
Thank you. Have a good one.
Bye.
Bye.
So did we lose Desmond? Hi. Just a quick wrap up for today. Marta, thank you. Desmond, is he joining us for this wrap up?
Yeah, I think I lost him for a while, so
lost him. So just a big thank you from QUBE Events. We'd like to thank again our sponsor, iSpiral. Thank you so much for sponsoring today's event. A big thank you to Desmond Leong for chairing the event today. For all our speakers, participants, I know that we had some blank spaces in between there with some technical issues, but we managed to sort that out, thank goodness. Again, big thank you to the QUBE team. A very, very big thank you to Contentworks, who partnered with us in this event and really added so much value to today's discussions. Marta, for putting together the content, always doing an amazing job. Thank you, Marta. I'll hand over to you now. And as we said, we are looking to build the brand with the Big Forex Breakfast, and we hope to host the actual breakfast in Limassol in 2021. We can't wait for that. So thank you, everyone, and we will see you soon for the next webinar. Thanks, Marta. Your words?
Nothing to add. Just many things from my side. Great speakers, technical issues. As always, I can say, but yay, that's a bit of adrenaline, and yeah, hoping to see you next time.
Wonderful. Thank you so much, everybody. Have a lovely day. Thank you.
Thank you. Bye-bye.